I sold 15% of my physical silver position this afternoon at an average realized price of $80.17 per ounce. Not because I think the silver bull market is over, not because I believe the long-term fundamentals have changed, and not because I'm turning bearish on precious metals broadly. I sold because the specific technical, positioning, and macro setup that exists right now on Thursday, April 16th, 2026 at $80.33 has a historically documented pattern of producing sharp corrections within 5 to 12 trading days. And I would rather take profit near local highs and redeploy that capital at lower levels than ride a drawdown that the data says is coming. This is the bear case nobody in the silver community wants to discuss right now because silver is up more 147% year over year. The momentum is strong, the fundamentals are bullish, and everyone holding metal feels vindicated after surviving the correction from $121.67 down to $70. But uncomfortable truth is always more valuable than comfortable delusion. So let me show you the exact data points that triggered my decision to take 15% off the table today, and why the next 2 weeks carry significantly more downside risk than the silver Twitter echo chamber is willing to acknowledge. Start with the CME margin requirement trajectory because this is the single most reliable predictor of short-term silver corrections in the modern futures market era. Since January 1st, 2026, the CME has implemented 3 separate margin increases on COMEX silver futures. The first hike on January 7th raised initial margins by 47%, from $6,500 per contract to $9,500 per contract. The second hike on January 13th restructured the margin system to a percentage of underlying basis rather than fixed dollar amount. The third hike on February 6th raised the percentage from 15% to 18% of the contract's notional value. Each margin hike was followed by a silver price decline of 12% to 31% within 7 to 14 days. Right now, with silver at $80.33, the current 18% margin requirement means a trader must post $7,229.40 in initial margin to control one 5,000-ounce COMEX contract. That is the highest nominal dollar margin in COMEX silver history, higher than the margin posted at the 121.67 all-time high, because the percentage requirement has been raised since January. Here is what matters for the next 2 weeks. The CME has explicit authority under Rule 802 to raise margins at any time without advance notice if volatility metrics trigger internal risk thresholds. Silver's historical volatility over the past 30 days sits at 68.4%, well above the 45% threshold that has historically triggered CME margin reviews. Silver's implied volatility on at-the-money options expiring April 25th closed Thursday at 97.3%. The highest reading since January 30th, the day before the 31.4% crash. The pattern is clear. High realized volatility plus high implied volatility plus silver. Above $80 elevated probability of a fourth margin hike within the next 5 trading days. If that hike comes, and I'm estimating 65% probability it does before April 23rd, the historical precedent from the prior 3 hikes suggests a 10% to 18% correction follows within 2 weeks. From $80.33, a 10% to 18% correction targets $65.87 to $72.27. I would rather sell 15% at $80.17 today and buy back 18% and 20% at $68 to $72 in 2 weeks, than hold through a margin hike-driven flush that the data says is more likely than not. The RSI divergence on the 4-hour chart is the second technical red flag that most bullish analysts are ignoring. Silver's price made a higher high this morning at $81.08 compared to Tuesday's high of $79.85, but the 4-hour RSI made a lower high, 68.7 this morning versus 71.3 on Tuesday. This is textbook bearish divergence, where price strength is not being confirmed by momentum strength, signaling that the rally is running on decreasing participation and is vulnerable to reversal. I have tracked 17 instances of 4-hour bearish RSI divergence in silver over the past 24 months. 14 of those 17 instances were followed by corrections of 4% to 9% within 3 to 7 trading days. That is an 82% historical accuracy rate. A 4% to 9% correction from $80.33 projects $73.10 to $77.12, which overlaps perfectly with the margin hike downside target range. The COMEX open interest behavior. Thursday is another warning sign being overlooked. Open interest increased by 4,121 contracts, while price rose 1.03 from Wednesday's, close to Thursday's close. Rising open interest on rising price is typically bullish. It signals new longs entering rather than short covering. But when you break down the timing of the open interest increase, a different picture emerges. According to the CME's preliminary timestamped data, 3,847 of the 4,121 new contracts, 81.5%, were added between 8:20 a.m. and 9:45 a.m. Eastern during the initial morning rally to $80.85. After 10 a.m., open interest was essentially flat to slightly declining, even as price chopped in the 80.40 to 80.90 range for the rest of the session. This pattern, aggressive open interest expansion on the morning spike, then flat to declining OI during the afternoon consolidation, is characteristic of late cycle momentum buying, where retail and algorithmic trend followers pile in at local highs while professionals distribute into that buying. When the momentum buyers realize the breakout is not extending, they exit quickly, and the open interest collapses back down while taking price with it. The Globex overnight order book depth is flashing another warning that I have rarely seen discussed in silver analysis. As of 7:15 p.m. Eastern Thursday, approximately 13 hours before Friday's pit open, the level 2 depth of market data shows sell orders stacked 73 contracts deep at the 82.00 level and 91 contracts deep at 83 $, while buy support at 79 $, is only 29 contracts deep, and at 78 $, is 37 contracts. This creates a 2.5 to 1 sell to buy imbalance on the order book at key round number levels. Large sell orders stacked above the market signal that someone, likely a commercial hedger or a large speculative long-taking profit, is willing to aggressively sell any rally toward $82 to $83. Thin buy support below the market signals that if selling pressure accelerates, there is limited buying interest to absorb it until price falls to $77 to $76. This order book structure creates asymmetric risk, where the path of least resistance over the next 24 to 48 hours is down toward $77 to $78 rather than up toward $82 to $83. The dollar's technical setup is another factor that argues for caution despite the current 6-week low at $98.09. The DXY has formed a falling wedge pattern on the daily chart, a typically bullish reversal structure where the dollar has been making lower highs and lower lows within converging trend lines. The wedge is now at its apex with the lower trend line support at 97.85 and the upper trend line resistance at 99.40. Falling wedges resolve with an upside breakout approximately 68% of the time in currency markets. If the dollar breaks above 99.40, which would only require a 1.3% rally from current levels, the inverse correlation to silver suggests silver immediately tests $78 to $78.50 support. Given that Fed Chair Powell's term expires May 15th and the Kevin Warsh transition is creating leadership uncertainty that typically supports the dollar as a safe haven, I am assigning higher than normal probability to a dollar bounce over the next 2 weeks, which mechanically pressures silver regardless of silver-specific fundamentals. The put-call ratio in silver options closed Thursday at 0.52, meaning there are 52 put contracts outstanding for every 100 call contracts. A ratio below 0.60 indicates speculative positioning is heavily skewed bullish, with far more traders buying calls, betting on higher prices, than buying puts, hedging downside. Historically, when the silver put-call ratio drops below 0.55, it has preceded corrections 9 out of 12 times over the past 36 months. The current 0.52 reading suggests the options market is extremely one-sided bullish, which is a contrarian sell signal when combined with the other technical and positioning warnings. The correlation breakdown between silver and copper this week is another subtle warning sign. Normally, silver and copper, both industrial metals with significant electronic and manufacturing demand, trade with a positive correlation of 0.65 to 0.75. Since Tuesday, that correlation has fallen to 0.31, the lowest 3-day correlation reading since March. Copper closed Thursday essentially flat at $4.87 per pound, despite silver rallying 7% this week. When silver decouples upward from copper, it often signals that silver's move is being driven by speculative momentum and safe haven flows rather than genuine industrial demand expectations. Moves driven by speculation and safe haven sentiment reverse faster and more violently than moves driven by fundamental demand because speculative and safe haven capital is hot money that exits at the first sign of trouble, while industrial demand is sticky and adjusts slowly. The Treasury auction results Thursday carry implications for silver that are being underestimated. The $22 billion 20-year bond auction at 10:15 a.m. Eastern had a bid-to-cover ratio of 2.31, well below the 6 auction average of 2.47. Weak demand for long-duration U.S. debt typically drives yields higher, and the 10-year Treasury yield spiked 7 basis points from 4.26% to 4.33% immediately after the auction. Rising real yields are historically negative for non-yielding assets like silver because the opportunity cost of holding metal increases when you can earn higher risk-free returns in treasuries. If the weak 20-year auction is signaling broader treasury market stress, and I believe it is, given the $36 trillion national debt and ongoing concerns about fiscal sustainability, then yields are likely to continue grinding higher over the next several months regardless of Fed policy. A 10-year yield, moving from 4.33% toward 4.60% to 4.80%, would create significant headwinds for silver, even if the physical supply-demand picture remains tight. The ceasefire expiration timeline is creating a binary risk event that I do not want full exposure to. The U.S.-Iran ceasefire formally expires April 21st to 22, 5 to 6 days from today. If a ceasefire extension or peace framework is announced over the weekend or early next week, the safe haven bid that has supported silver's rally from $72.61 to $80.33 evaporates instantly. Oil would fall from $96 back toward $80 to $90. Inflation expectations would ease, and silver could gap down $3 to $5 on the headline alone before recovering on the monetary easing narrative. I would rather not be holding full exposure through that potential gap down. Conversely, if the ceasefire collapses and conflict resumes, silver could gap up $4 to $7, but that move would likely be short-lived because a return to active conflict also reignites inflation fears, pushes the Fed back toward a hawkish hold, and strengthens the dollar, all of which are medium-term bearish for silver even if the initial safe haven spike is bullish. The risk-reward of holding through the ceasefire binary event is unattractive when you can take profit at $80.17, sit in cash through the uncertainty, and re-enter at better levels after the volatility resolves. The FOMC blackout starting Saturday, April 18th, just 48 hours from now, is another reason I'm reducing exposure rather than adding. During the blackout, no Fed official can provide forward guidance, which removes the central bank communication buffer that has historically dampened extreme moves in precious metals. The last two FOMC blackouts during periods of elevated silver volatility produced the 31.4% single-day crash on January 31st and the 26.9% single-session drop on March 23rd. Both crashes happened during blackouts when the Fed could not talk the market down or provide stabilizing language. I'm not predicting another 30% crash, but the absence of Fed communication during a period when ceasefire risk, PCE data, and May-COMEX delivery stress are all converging creates an environment where tail risk events are more probable than normal. Selling 15% reduces my exposure to that tail risk, while keeping 85% of my position in place to benefit if the bull case plays out. The seasonality pattern for silver in late April also supports reducing exposure. Over the past 20 years, silver has had a negative average return of 1.8% in the final 2 weeks of April. This is partly driven by tax loss harvesting in non-retirement accounts and partly driven by options expiration dynamics on the April contract. While seasonality is not predictive, it does reflect historical patterns of capital flow that tend to repeat because they are driven by structural calendar events rather than randomness. Let me be very clear about what I am not saying. I am not calling a top in the silver bull market. I'm not saying silver will not reach $100, $120, or $150 in the next 12 to 24 months. I'm not arguing that the long-term fundamentals, the sixth consecutive deficit year, the 762 million ounce drawdown, the COMEX delivery stress, the Asian physical demand, are anything other than bullish. What I am saying is that the short-term setup at $80.33 on April 16th, 2026 has a statistically elevated probability of producing a 5% to 15% correction within 5 to 12 trading days based on margin hike risk, bearish RSI divergence, put-call ratio extremes, weak order book support, dollar wedge breakout potential, ceasefire binary risk, and FOMC blackout timing. I sold 15% at $80.17 because I believe I will be able to buy back 18% to 20% at $68 to $74 within 2 weeks. If I am wrong and silver goes straight to $88, I still have 85% exposure and I participate in 85% of that gain. If I am right and silver corrects to $70, I have 15% in cash to redeploy at prices 12.7% cheaper than where I sold, increasing my total ounce count by 2.3% for the same capital. That is asymmetric risk management, not bearish sentiment. This is the hidden AG. Man, Thursday, April 16th, 2026. Sometimes the hardest trade is taking profit when everyone else is chasing.